that we spoke to Mr. Manish Bhatnagar of SKF, we got an insight into how the upcoming decade, or the decade that we are in currently, could be a decade of manufacturing. They have an eye into the plans of India Inc., which is on the manufacturing side, because they are just so well entrenched in that whole space. The questions to Mr. Manish Bhatnagar would be as much about their quarter and the 9 months gone by and their own performance, as also what is his post-budget view after the kind of Capex thrust that the finance ministry has announced. So Mr. Bhatnagar, great having you. Thanks for joining in. Hope all is safe.
Thank you, Neeraj. Yes, excellent. Thank you for having me.
The pleasure is ours. Can I just start off with the micro and then kind of zoom out into the bigger picture? When I looked at your numbers, the revenue growth numbers at about 17-18%, circa 17-18% looked okay. Can you tell us a bit about what went behind that, and also the revenue mix, if you will, traded versus manufacturing for the quarter and for 9 months?
Well, yeah, just to refresh our memories, sometimes people forget what we do. And so we are a mix of industrial and automotive. It's about half-half. And within those segments, we have a mix of OEMs and the aftermarket. And what you're referring to, the revenue growths have been pretty strong across. Automotive past quarter has been a bit of a slowdown for reasons that I'm sure you've seen elsewhere also. Industrial, on the other hand, has shown pretty good growth across segments. So what you refer to as the Capex cycle, we are certainly seeing benefits of that. It's still early days, of course, but we're seeing some early shoots there. On the mix of the product line, clearly aftermarket is more margin accretive than OEMs. And we are seeing the benefit of that. We're going out with a full thrust on the vehicle aftermarket and the industrial aftermarket. So you're seeing some favorable product mix there. But nevertheless, margins have remained under a bit of a pressure, mainly because of cost inflation. And we will offset some of that through price increases, but our price increases sometimes take a lag because of the contracts that we have signed. And those pricing actions that we initiated 2 or 3 months ago will start bearing fruit, if you will, this month and beyond this month.
Okay. So the drop in gross margins was not due to an adverse trading mix or otherwise. It was largely due to cost inflation.
Well, both, I would say. It's cost inflation and trading mix. Keep in mind, if industrial grows faster than automotive, as has been the case with us last quarter, industrial has a higher trading mix than automotive has. So by that logic, the trading mix is more favorable. We need to have more trading products in our mix than manufactured products, and therefore it has.
Okay. And did I hear you say that you are going to take further price hikes, but some hikes being taken, and therefore both for the months of February and March, you would see some bit of offsetting of those margin pressures that you saw in Q3?
Yes, so we will see price impacts getting realized in February and March. And of course, you will see further price actions beyond March.
Okay. Also, I'm just wondering, Mr. Bhatnagar, would you, with all your strengths as well, be facing issues regarding supply chains, I mean, components, finished goods, what have you? Is it becoming a problem both inward as well as outwards for you? I'm presuming there is some bit of outward part as well here.
Well, not too much of an outwards from here. We are heavily localized.
Okay.
Most of the factories are planned for consumption in India. There's a bit of opportunistic play for exports, but I would not comment. It's very small. More pertinent, inward flow of components. Certainly, there is a pressure both on timelines and costs. You've seen what's happened to freight costs recently. More than that, we've seen the delays in clearances, the delays in shipments. We are seeing jams at ports around the world. We're seeing surcharges being placed on freight shipments. So all of that is impacting us, unfavorably, unfortunately. Having said that, we are seeing a bit of those log jams starting to ease up last few weeks. So we are seeing, if you'd asked me this question, let's say last year in November, I would have been more pessimistic than I am now. And we are certainly seeing that clearing up.
Okay. There is a reference this time around of the new strategic framework, which will be linked to Q6, and then probably for the whole of SKF Global. I don't know what kind of part does or what kind of reference does it have to SKF India, but if you can talk a bit about that, if there is any bearing on SKF India as a result of that.
Sure. We announced a new strategic framework a couple of weeks ago. And I'll make it really short for ease of understanding. It's built around two concepts, clean and intelligent. And this is a response to the changes we see around us. Sustainability is a big part of what we are doing at SKF and what our customers expect us to do. So the first concept of clean is around that. So we will build strategies around clean technologies, clean products, cleaner supply chain, etc., both for our customers and for our own operations. The second concept is intelligent. So clean and intelligent. Now, you will recall, Neeraj, last time I believe we had spoken about our performance contracts, which are linked to intelligence at our customers' workplaces. So how can we help using technologies? It may be connected technologies, maybe some sensors, maybe some products, to use our 100 years of knowledge, our 100 years of deep understanding of industrial applications and technologies to be able to provide that intelligence to customers. I'll give you a very simple example. Customers don't like unplanned failures. They don't like unplanned downtime. So if the plant is supposed to go down for planned downtime on, let's say, Sunday morning, they would like to know in advance of Sunday morning, where should they focus on? So if they only have a 3 hours downtime, okay, so we can help them to our predictive diagnostic services that, hey, focus on this part of the plant because these bearings are more prone to failure than some other part of the plant. And that's what we mean by intelligence. So these are the two concepts you will hear us talk more about in the days and years to come. And of course, India is a big part of it.
It's interesting. Yeah, and I don't understand your business as well, but let me try and make an attempt to ask you a follow-up on this. On the intelligent part, I'm sure every customer would love that. I think Indian companies are now matured enough to understand that there is merit in even paying a premium for such a solution. What global consultants largely tell me is that on the clean energy side or the clean green way of doing business, the discerning Indian customer is choosing a middle path. She's not saying a global consultant that I don't want your services at all, but the Indian company is telling the global customer that I don't want all of your services because I have to be cost conscious, which is probably not the case in a lot of other global companies. So since you are largely focused on the Indian landscape, how do you reckon your clean energy or the clean manufacturing focus, which might probably be slightly more expensive than normal, be taken by the average Indian customer from you compared to some of the other products that other competitors might be offering?
And great question. Let me answer it in a couple of different ways. Number one, I do want to remove this fallacy that clean is always expensive. So what you said, clean and cost consciousness can sometimes and very often go hand in glove. I'll give you a very simple example that we see all around us. Renewable energy. We have at our factory in Pune, if you come here, Neeraj, and you're welcome to come here sometime, you'll see on the roof of our factories, we have solar panels installed. In many of our factories, we are pulling in renewable energy as opposed to fossil fuel energy. And you'll be surprised to hear that renewables, in our case, has reduced our energy consumption, reduced the cost of energy by almost 30-35%. So not only is it green, it's also better cost for us. So this is a good example where both do go hand in glove. But having said that, I think the spirit of the question is a bit larger. Having said that, I agree with you. There is different countries are in different parts of adoption. And India may be a little bit far behind than some other countries, maybe a little ahead of some other countries. But there's no gainsaying that at some point in the future, it could be 2 years in some sectors, could be 5 years in some other sectors. Green or clean will be the accepted norm of doing business. There's no getting away from that. Prime Minister Modi has already announced net zero targets, and we are bound by those targets. So it's only a question of time. Electrification is a good example. electrification of vehicles. Now, we may be far behind other countries, but you read the news, I read the news, it's moving at a very fast clip.
True.
It won't be very, very far along when we will replace a lot of vehicles on the road with electric vehicles. So again, it's a journey we are on, and some countries will get there faster, some slower, but we'll all get there eventually.
Okay, cool. Okay, now on to Capex. You gave us fabulous insights in the last time that we spoke about what is upcoming ahead of us. There is also a budget now that we put behind us. Trying to understand how strengthened are your views around this, and also give us some flavor, Mr. Bhatnagar. I forgot to ask you this the last time, but in the Capex that you are already seeing from your clients, or your clients are talking to you about needing your services in the near term, is it fresh Capex that you see a lot more of, or is it maintenance Capex as yet? Because a bunch of industries tell me that the capacity utilization levels are not quite up there as yet.
Yeah. So, with your permission, Neeraj, let me go back a little bit macro here, and I'll come to the micro question on Capex. And I'll also reference the budget you talked about. Now, the budget, with your permission, the budget is a one-time event, and we should not, I think we've gone away from this story that we had 10 years ago. The budget is the most important thing in the country, which is not anymore, and thankfully so.
Thank you.
So a number of things have happened, and the budget is only one part of it. There are a few macro indicators that we have to absolutely watch, and that gives us a clue in terms of what Capex will follow. So, for example, you may know this, the gap between mortgage interest rates and the rate of rental returns on property is at an all-time low. We have not seen that gap closing to where it is right now. And this means that people, and I know you're looking at it, confused now, so let me explain a little bit. So it simply means that if I take a loan to buy an apartment, the interest rate I pay on that loan in the past has been much higher than the rental return I'll get from the property. So it wasn't attractive for me to go and buy an apartment. That gap has now reduced to an all-time low. And that means we are seeing many more investors, many more people going out and buying property. Real estate will pick up. Now, why am I saying this? This has a domino effect on things like cement, on things like steel. So we will see, which means those companies that you're referring to are seeing a low capacity utilization will start seeing more and more, and therefore they will need to put in more Capex to build more plants. So that's one macro indicator that we all track and we should track here. Specific industries, and we can talk about defense, for example. For the first time, the government is now stressing very, very hard on defense being as local as possible. India, for a long time, was one of the largest importers of defense equipment. That's going away now. And we are seeing a lot more companies, at least creating infrastructure for making localized defense machinery. We're also seeing, in the last couple of years, India investing very hard in building a three-tier, if you call it three-tier line of defense at our borders. So tier 1, tier 2, and tier 3. Think of it as one line behind the other. And this is also new for India. And all three lines will be mainly localized equipment and localized sourcing. So what does it mean? It means folks who are in the defense industry will now be putting in more Capex to meet the new demand. And this is a stated policy by the government. I'm not making up anything new here. So a couple of examples here. So how do you take the macro to the micro? These two examples on housing and defense, which means will lead to a lot more Capex now in cement, steel, construction equipment, defense industries, aluminum, and we benefit from all these. And I can give you more examples, but that's not the point here. The point is that we are seeing macro indicators beyond the budget helping the industry. And therefore, we are seeing Capex starting to pick up now in response to those macro indicators. And no, it's not just maintenance. We are seeing people who are a little bit far-sighted are seeing these macro indicators and investing in new machinery. We are seeing new orders being placed for new equipment or new factories. And these things have a lag, of course. So I expect in the next 12 to 18 months, those assets will become productive and good for all of us.
Okay. So suffice to say that compared to what it was, the current spate of non-maintenance and fresh capex is certainly looking a lot more up, and it will likely be in the same trajectory in the months to come or the quarters to come. Let me put it that way.
Well, quarters and years to come.
Quarters and years to come.
Because capex in the industry takes time. The last private capex cycle was about 10 years ago.
Sure.
And I think it's the first time in the last 10 years, I have seen false starts, many false starts. I come on a channel like yours and you ask me a question, and I say, yeah, we are seeing capex investment picking up. At the end of 2 months, I look like a fool. But this time, I think it's more than that. This time, we are seeing more than just announcements. We're really seeing actual orders being placed. And I'm very encouraged by that.
Okay. So in all probability, if not in Q4 and if not in Q1, very shortly, and I'm guessing it's difficult to time, but the revenue, the growth numbers on the top line would start looking even more impressive because as capex picks up. My question is, do you reckon it's possible to have some bit of a handle on how do you manage the cost pressures? Simply because I hear mixed responses from companies. Some companies are sounding resigned to the fact that we are not even talking about what will happen to the margins because it's just impossible to predict it in the current volatile world. And some are saying we're trying to do a few things here and there. It is difficult, but we are trying to get a handle on it. And both are equally right and equally wrong. I'm just trying to understand your point of view here.
Yeah, I think we are certainly not in the first group of companies that we are resigned to the fact that that margins will go down, or certainly not. We're having very active discussions with our customers on price increases. And that's only one part of the inflation. We can also take a look at our own costs because margins are a function of both pricing in the market and, of course, how productive we are. So I think both those activities are ongoing. And certainly, I'm hopeful in the next few quarters to come, we will get back to where we were.
Awesome. My final question, Mr. Bhatnagar, would be on market share, because I'm guessing you keep an eye out for that, being the market leader that you are, by virtue of the design of the products. Because I heard you say the last time that you may not have as much volume growth, but the value growth will be tremendous for you simply because of the nature of the components that you release in the market and the design and the ask of the companies. But market share would probably be encompassing all of this because it will be the same for other players as well. How is the market share situation currently compared to what it was, say, 12, 18, 24 months ago? And how do you anticipate it to be in the months to come?
Right. Just to clarify, Neeraj, I made that comment of volume versus value in the context of electrification. So when I made the comment, it was in the context of in electric vehicles, the number of bearings may go down. The performance goes up, and therefore the price per bearing is higher. But irrespective.
Thank you for correcting me.
That's cool. The more important question is, how do we see market share evolving over time? And I think, unfortunately, in the bearing space, there is no credible market research agency that can point us, unlike consumer goods, that this is our share last month, this is our share the year before, etc. So it's really a best guess we have. And the indications that we have based on what we see in the market, we maintain pole position in many of our segments, and that has not changed.
No, that I'm sure of. You not have lost the pole position. Have the percentages internally, what the calculations show, have the percentages come off a bit, and they could have come off because it is natural as well. I'm just trying to understand that while you maintain the pole position, have the percentages changed?
No, on the contrary, we have improved our pole position. And simply because, a few things have happened, and we spoke about this last time. I don't know how much time you have, but I'll make it really, really quick. Industrial growths that we began this conversation with have been very strong for us. And many of our competitors are, they have a larger business on the automotive side and less on the industrial side. So by virtue of industrial growing more for us and industrial demand picking up, we have gained share in the industrial segments. And that translates into overall share. And the second thing I'll say is that we are certainly facing supply side constraints. You mentioned that. There was an import of bearings that was happening a lot into this country, that has slowed down because of supply side constraints. And it's allowed players like us to bridge that gap. So we are doing import substitution with local production, and that's also helped. And of course, when you substitute imports, the largest players get the most benefit. So that's also helped us.
Great. Okay, this was lovely talking to you, Mr. Bhatnagar. Thank you so much. And every conversation with you gives us an insight into where India Inc. is moving towards in the Capex cycle. And thank you for that as well. And thanks for throwing some light on the numbers. Stay safe and look forward to talking to you more often.
Thank you, Neeraj. Take care. Bye-bye.
Bye-bye. And viewers, thanks for tuning into this edition of The Talking Point.